We need your support. Click the like buttons below. Now onto the video. Welcome to readtheticker.com. Today we're going to help out our gold and silver investors, and we're going to do it by studying the reserve currency in the interest rates of the 10-year yield and the US dollar DXY index, and explain how pretty much the interest rates in the US dollar are responsible for the major moves in the gold and silver, and just quickly show how. So in front of me I'm using a combination chart, and I have the brown is the 10-year interest rate and the black is the US dollar and the DXY. We've got a weekly chart and we've got it going back to about 1997, so it's a pretty big time frame. Now what I want to show you is this blue line here. I've called it the RT reserve currency. This is a custom index, and in readtheticker.com you can build your own custom indexes. I can show you the settings here for members so they can do their own playing around. Well, let me explain. So what I've got here, I've loaded in the TNX and I loaded in the DXY. I'm giving the weighting of 90 to 10. Okay, so that basically means we're going to be using I've got the line down here, percentage. The weight is treated as percent of applied to the price of each, then summed. So the TNX moves between 0 and about 4 or 3, okay, because that's 3, it's not a very big number. But the DXI moves between 50 and 100. So a percentage change on the DXY is going to be on dollar terms is going to be greater than the TNX. So what I do is, because the TNX is such a small number, I give that a larger weighting, and the DXY, because that's such a large number in the price, I give that a smaller weighting. So I want an equal influence. I just adjudge the weightings to cater for the numbers used in each different time series. Like, I'll just say that again. The TNX has a time series of of numbers under 3, and the DXY has a time series of numbers going up to 100. So I have to balance those out to get a equal measure of the percentage change. So the index basically goes through and works out the percentages of each change, adjusts it for the price, then adds them up. Okay, we get what the RT reserve currency. So that gives me this blue line here. Okay, as you can see, we get a downtrend here. As you can see, the black line sort of downtrend bottoms in and goes sideways a bit, but the interest rates are still falling. So I'm going to say the downtrend started there, and it pretty much sort of ended there. And then we had an uptrend in the RT reserve currency. It sort of went up and sort of stopped about there. You can see it sort of breaks the trend line there. And then we have a little uptrend here. So we've got a downtrend there and uptrend there. That's how the index here is a marriage of these two in percentage terms. So if I scroll up, I want to scroll up to the gold. Here you can see I've got the downtrend in the blue line, and it corresponds to the gold trend up line. I've got the downtrend in the gold and a little sideways, and it corresponds to the uptrend in the blue line, which is the RT reserve custom index, which is calculated. We've got a strong downtrend in the blue line, and it corresponds to an uptrend in the gold. And now we've got the spike up in the blue line, and we've got the sort of short sort of consolidation in gold. Okay, so basically when the US dollar is rising along with the interest rates, it's bad for gold and silver. But when the US dollar is falling, as well as US interest rates, I'm using the 10-year, then it's good for gold and silver. Okay, so here's silver. Once again, downtrend going down, silver goes up, and it's a bit more sensitive. It sort of reacts a little bit quicker here. See how silver topped out as the strength came into the market? Okay, silver had this big rally when both the bonds and the US dollar fell. So if I scroll down here's the bonds that fell hard. US dollar didn't fall hard at the first, then it fell hard later on. But that really pushed them, because the reserve currency is made up of interest rates and the currency, you have to weigh the two together. And because the bonds fell so hard relative to the US dollar, and if the silver investors and the gold investors really took advantage of that. You see that? So now we get, like I said, silver's gone sideways or down because of both US dollar and interest rates finding strength. Now looking forward, people are, the Fed comes out and says inflation is now structural, which implies that it might be going on for a little bit longer. and that suggests higher interest rates, which suggest a higher dollar. I go fully on that. I'm going to go with David Rosenberg, which basically says the inflation is a result of supply chain issues. That's all those boats in the harbour, what have you, and if they can be sorted out and a few things change, say in 6 months, inflation will roll over. Crude oil will probably roll over as well, and that means inflation will peak out in Q1 and Q2 next year and start rolling down. And I think with the talk of the stimulus running out in 2022 and the so-called fiscal cliff, that fiscal cliff is basically government spending is coming to a halt, and it's a drop-off of the economy. The US economy is going to have a serious stimulus problem, and now I think Goldman Sachs is adding to the woes of the forecast of the US economy of this Omicron variant coming out of Africa, which may or may not cause more economic trouble. So if you add all that up together, Rosenberg and a few others and a couple of servers I follow suggest inflation is going to peak and taper from 6 or 7 and roll down to the 4s or 3s, okay? And then eventually turn to the 2s, because there's too much deflationary forces out there, and the fiscal cliff and a few other stimuluses out there, and the Fed will be forced to not raise interest rates, and maybe even be forced to bring back the stimulus. And like I said this morning, the date is the December the 5th, 2021. Goldman Sachs comes out with a report saying GDP could fall into the negatives due to Omicron and a lot of other things. So they're already making waves to give the Fed an excuse to not to taper and not raise interest rates, whereas only a week ago they were talking about speeding up the taper. So we might have a Powell double pivot. So I would be very concerned about the US economy doing that well. It have to require more stimulus. Now, if there's no stimulus from Congress, there's going to have to become stimulus from the Fed to maintain asset prices up. We want the rising asset prices in the stock market going up faster than a falling bond market. So what that basically means is the dollar will be overvalued, interest rates will probably wander on down to 1, and the DXY will probably wander back down to 90 or something like that, or even 89. It probably extends, so that means a falling dollar, falling bond rates, which basically means the blue line will wander on down under my thesis, and that will give a forecast for gold and silver to do rather well. Now, while we're talking about it, because everyone wants to know about Bitcoin, if I type in BTC in here, BTCC, give that a bit of a red one. Let's see what happened to Bitcoin. Now you're going to see that Bitcoin, its best moves happen when the blue line RTRS reserve currency, wrong index. Bitcoin does really well when the US dollar is falling and interest rates are moderate to going down. Okay. All right, here we go. Right, here's a big rally in Bitcoin. The big rally to 20,000. Both. I'll get that better position. US dollar was falling and bonds were going sideways to down. Okay, rally in the Bitcoin. Bonds are collapsing. Dollar was going sideways. Rally in the Bitcoin. US dollar was falling hard, and bonds were going up, but the biggest weighting is on the dollar. Okay, so that basically see how the blue line was still going down. This little rally here, that was I believe that was just a small rally up to resistance, I believe, in anticipation of this blue line falling down. Okay, so the big boys are getting in position for another move down the blue line. Another leading indicator for an expectation of the blue line to fall down, that's bond yields going to 1 or below, and the US dollar going from where it is now, what is it doing, 96, maybe back down to the 89s, is when we look at the gold and silver index, the Philly gold and silver index, we can see that it's a little bit more sensitive, so it's sold off before the turn in gold. See that? And we can see here it's still holding up. So this thing here would have tanked dramatically if they thought this blue line was going to charge up high. Here, gold and silver stocks would have just tanked hard. So it hasn't tanked hard. So when this blue line starts rolling over and the bonds start falling down and the dollar starts rolling over, as they believe the US economy isn't going to be doing so well due to the weaker stimulus, fiscal cliffs and Omicron and all that sort of carry on, I think gold and silver stocks will go up with the gold price. So that's a simple trick to see the big fundamentals and how the US dollar interest rates can affect both Bitcoin, gold and silver, gold stocks, and what's coming up for the future. So thanks for watching. Watch for the US 10-year and the US dollar to roll over in the next 1 or 2 quarters, which will spark life into gold and silver stocks, and most likely Bitcoin. Thanks for watching.